In this video, we're going to look at Warren Buffett's letter to shareholders from 2023. I'm going to share my 11 biggest takeaways, starting from the least important all the way to the number one most important takeaway that I got from the letter.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Number 11, public markets are more irrational than private markets. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling, their behavior usually understandable only in retrospect. Controlled businesses are a different breed. They sometimes command ridiculously higher prices than justified, but are almost never available at bargain valuations. Unless under duress, the owner of a controlled business gives no thought to selling at a panic-type valuation. I've always thought of private equity as having some sort of an advantage because they're able to buy privately owned businesses. However, Buffett is saying that those owners rarely will sell their business at a good value. Typically, they're either going to demand a fair price or a better than fair price. And the reason is that those managers tend to know a lot more about the business than someone else, and so they're not going to sell it for just anything, right? They're not going to panic and say, "Oh no, the economy's down, my business is now worth 50% less." They see it as more of a long-term investment, and they see that the business actually has a lot more earnings power, even despite whatever short-term headwinds there are. Public markets, on the other hand, are often subject to boom and bust cycles, which actually gives us as public market investors an advantage. If you can keep your cool and buy things that other people are just throwing out for a lot less than they are worth, you have a major advantage in the public stock markets. Number 10, stock buybacks are not evil. First of all, he talks about the benefits of share buybacks for individual investors. One term you'll hear thrown out a lot is the term financial engineering. So the connotation with share buybacks is that they are bad for investors, or somehow the managers are trying to pull a fast one on investors. And really, he's saying that's not true. So he says the math isn't complicated. When the share count goes down, your interest in our many businesses goes up. Every small bit helps if repurchases are made at value accretive prices. And the key there is if. Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only to the selling shareholders and to the friendly but expensive investment banker who recommends the foolish purchases. In other words, share buybacks are good for you for a continuing shareholder if and only if they are made at fair or less than fair prices. Shares that were purchased above their fair value only benefit the selling shareholders. And then he goes on to give an illustration. Imagine, if you will, 3 fully informed shareholders of a local auto dealership, one of whom manages the business. Imagine further that one of the passive owners wishes to sell his interest back to the company at a price attractive to the 2 continuing shareholders. When completed, has this transaction harmed anyone? Is the manager somehow favored over the continuing passive owners? Has the public been harmed? And of course, the answer to these questions is no. And here's where he makes a kind of a political jab. When you're told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. Characters that are not mutually exclusive. So when you hear a politician ramble on and on about how evil buybacks are, just remember they're not harming anyone, they're not harming society, but they are harming existing shareholders if done at foolish prices. Other than that, there is nothing ethically wrong with a share buyback. Number 9, don't leverage. And this is a quote that he pulled in from Charlie Munger within the letter itself. Munger says, "There's no such thing as a 100% sure thing when investing. Thus, the use of leverage is dangerous. A string of wonderful numbers times 0 will always equal 0. Don't count on getting rich twice." As I talked about in a video about TQQQ back in 2021, It was, obviously doing extraordinarily well. But the problem with a triple leveraged or double leveraged or really any leveraged investment is that it magnifies any losses. So a triple leveraged ETF, where the underlying goes down 30%, like QQQ did, the triple leveraged is going to go down 90% or maybe more, depending on the compounding effects. No matter how well the investment has done, if you take a huge hit, a negative 90% or greater, you're basically going to wipe yourself out. Number 8 is that mistakes are inevitable. Buffett says, over the years, I've made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, more on that in a minute, many that enjoy very good economic characteristics, and a large group that are marginal. Along the way, other businesses in which I have invested have died, their products unwanted by the public. Capitalism has two sides. The system creates an ever-growing pile of losers while concurrently delivering a gusher of improved goods and services. Schumpeter calls this phenomenon creative destruction. So even one of the greatest investors of all time said he's made many mistakes, including those bad enough that the businesses he bought actually died out completely. So don't be discouraged if stocks, several stocks, or even most of the stocks in your portfolio do average or worse. As long as you have a few big winners, those will make up for the losers and then some. Number 7 is keep learning. Another quote Buffett pulls in from Munger, you have to keep learning if you want to become a great investor. When the world changes, you must change. Since you're watching this YouTube video, I know that you are the type of person that wants to learn and get better at investing and probably everything else you do in life. Continue to do that even as you grow in your knowledge. Never stop learning. Number 6, earnings can be tampered with. An important warning, even the operating earnings figure that we favor can easily be manipulated by managers who wish to do so. Such tampering is often thought of as sophisticated by CEOs, directors, and their advisors. Reporters and analysts, so company analysts, embrace its existence as well. Beating expectations, meaning the analyst earnings expectations that they make every quarter, is heralded as managerial triumph. That activity is disgusting. It requires no talent to manipulate numbers, only a deep desire to deceive is required. Bold, imaginative accounting, as the CE once described his deception to me, has become one of the shames of capitalism. Once a quarter, analysts and company CEOs do this little dance where they go in, report the number for the share, and that either beats or disappoints expectations. And what Buffett is saying is that it's not terribly difficult to match the expectations that Wall Street puts on you, or even slightly exceed them with just a few accounting twists. Go check out Enron if you want a very egregious example of how that's possible. But even without blatant corruption, Buffett is saying that managers who wish to deceive shareholders via earnings can do so, which is why it can be very favorable to focus less on earnings and more on dividends. So number 5, dividends add up. This was one of the more fascinating parts of the letter, in my opinion. He talks about some of the purchases they made and what the dividends per share now are. So he says in August of 1994, Berkshire completed its 7-year purchase of the 400 million shares of Coca-Cola we now own. The total cost was $1.3 billion, then a very meaningful sum at Berkshire. The cash dividend we received from Coke in 1994 was $75 million. So a relatively meager sum compared with the amount purchased. But by 2022, the dividend had increased to $704 million, which is now over 50% of the entire amount originally paid. Said in other words, basically every 2 years, Berkshire Hathaway gets back its entire initial investment on Coca-Cola in dividends alone. So it has basically a 50% dividend yield based upon that cost. And he's saying dividend growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. We expect that those checks are highly likely to grow even into the future. Same thing with American Express. Berkshire's purchase of Amex were essentially completed in 95 and coincidentally also cost $1.3 billion. Annual dividends received from this investment have grown from $41 million to $302 million. These checks too seem highly likely to increase. The dividend gains, though pleasing, are far from spectacular. So he's saying, Coca-Cola raising its dividend at 8% per year, or Amex doing it at 10% per year, aren't that spectacular in the moment, but whenever you add them up, they are substantial. And he also goes on to add, but they bring with them important gains in stock prices. So he's saying as the dividend continues to rise, that eventually pushes the value of the stock higher. At year-end, our Coke investment was valued at $25 billion, while Amex was recorded at $22 billion. Each holding now accounts for roughly 5% of Berkshire's net worth, akin to its weighting long ago. So not only are dividend payments something that you can take out, reinvest back into the business, or spend on other things, which is what Berkshire did, but those dividend increases also eventually lead to a market price increase. And that is one of the true magical parts about dividend investing, which I talk about in another video. I'll put a link to that in the description down below. Number 4, be a business picker, not a stock picker. A great company keeps working after you are not. A mediocre company won't do that. And Buffett says our goal in both forms of ownership, meaning both public ownership and the private companies that they purchase, is to make meaningful investments in businesses with both long-lasting favorable economic characteristics and trustworthy managers. Please note particularly that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for adroit purchases and sales. That point is crucial. Charlie and I are not stock pickers, we are business pickers. And he finishes it off with a quote from Charlie. Ben Graham said, day to day, the stock market is a voting machine. In the long term, it is a weighing machine. If you keep making something more valuable, so think dividends, earnings, cash flows, then at some point in the future, some wise person is going to notice and start buying. So if you're focusing on the business fundamentals, and those business fundamentals continue to grow year after year after year after year, eventually the stock price is going to follow. So you do yourself a disservice by focusing on a stock. Maybe the stock price is going sideways or maybe even down. Focus on the business fundamentals. Pick great businesses and don't sell them if the stock price is down. Only sell them if you believe the fundamental value of those businesses is starting to deteriorate. Speaking of selling bad businesses, number 3 is don't waste time owning bad businesses. Nice quote from Charlie. He says, don't bail away in a sinking boat if you can swim to one that is seaworthy. So if you own a bad business that fundamentally is deteriorating year after year after year, like IBM, Intel, I think 3M probably fits that mold right now, don't waste your time owning that business, trying to, bail yourself back to even or whatever. Don't waste time in that ship. Swim over to something that is more seaworthy. And number 2, it only takes a few winners. Munger says, you don't, however, need to own a lot of things in order to get rich. There's a lot of business owners that have gotten rich just on one business, so don't focus so much on diversification. Focus on buying wonderful businesses at attractive prices, and Munger says that is how you are going to get rich. Our satisfactory results have been the product of about a dozen truly good decisions. That would be about 1 every 5 years, and a sometimes forgotten advantage that favors long-term investors such as Berkshire. So all of Berkshire Hathaway's success can be attributed to just a handful of good decisions. Even though Munger and Buffett have bought hundreds of businesses, only about 12 of them have really moved the needle in a meaningful way. So you don't need to have that many good businesses in order to really compound wealth rapidly, but you do have to have 1, the ability to see them, and 2, the ability to hang on to them long enough for that big wealth compounding to take effect. Which brings us to the number 1 lesson: be a coffee can investor. Munger says the world is full of foolish gamblers, and they will not do as well as the patient investor. Patience can be learned. Having a long attention span and the ability to concentrate on one thing for a long time is a huge advantage. Warren and I don't focus on the froth of the market. We seek out good, long-term investments and stubbornly hold them for a long, and he means long time, like not 10 minutes, like 10 years or more. And finally, from Buffett, the lesson for investors: the weeds wither away in significance as the flowers bloom. In other words, the weeds are the loser stocks, the loser businesses in your portfolio. Maybe they were once, 1% of your account, and they're going to wither away to, 0.1, or basically they're going to sell themselves. Meanwhile, the flowers bloom. So these are the great performing businesses, the great performing stocks in your portfolio. So those are going to increase in significance while the losers are going to decrease in significance. Over time, it takes just a few, again, remember they have 12 winners, to work wonders. And yes, it helps to start early and live into your 90s as well. Warren and Charlie are truly some of the most original, what I would call coffee can investors. They pick out the best businesses they can find, put them in the portfolio, and then let them do their thing. Some of them are probably not going to be as good as they thought. Those, however, will be like weeds. They will slowly wither away. Meanwhile, the flowers, the truly great businesses that continue to be great long into the future, buy great businesses, let them run, be patient, and as Berkshire Hathaway shows, wonderful results can occur. If you're interested in more about the coffee can investment strategy, I made a video about it, which you can check out right here.